we talk about the government's involvement in the real estate market. I think what's interesting in the presentation is to see how they are not only involved in fine-tuning, but also how they adapt and change quickly.
Yeah.
Right? Which means whatever you presented here could be changed tomorrow. Right? So one needs to pay attention to what are the drivers behind the policy as a way to think about anticipating the future.
Yes.
Right? It's very critical. Now we did ask you and ask the participants beyond China, what are the interests? And it was a bit of an empty question to ask beyond China because really there was so much focus. And we joked with the students that the reason there was this 10% Australia, New Zealand and 10% Japan is just a reflection of who is here. These are the Japanese they met who said Japan. But it's not totally true actually, because we were in panel with big foreign institutional investors finding interest in the Japanese market because there's been some good news coming out of the disaster with the tsunami, and it is a place for steady returns. So Australia and New Zealand, there's a sense in which it's a story that's already ending. These are tiny economies. There was a lot of interest in those markets, which really, when we talk about sales, there were purchases. It was just a reshuffling of the ownership of property that took place. Japan I just mentioned. We at MIPIM Asia, we hear a lot about Taiwan because they have really dynamic and enthusiastic politicians who want to sell the place, and there seems to be good things happening there. Hong Kong and Singapore, I don't want to go too much in depth because we have an expert here who can help us understand what's happening. The headlines I get from the conversations with you is the one difference that comes up is the difference between no supply coming online anytime soon in Hong Kong, very restricted. And then an interesting comment that I'd never heard before, that Hong Kong is a city which was planned without leisure in mind, versus Singapore, which is quite different, with a lot of supply coming in and certainly quite a bit of emphasis on offering you leisure opportunities, the kind that do cost money, actually. India and Russia, I think it's a bit of the same story for the past 4 years of, particularly India, of the missed opportunity. Lots of interest from foreign investors, but so difficult to enter those markets because of the regulatory environment, because of the infrastructure. Big economies, lots of growth potential in India, but very difficult to service and provide there. Indonesia is probably the country for which we've heard the most mixed feelings. On the one hand, some people being very optimistic and very encouraged about doing deals there. I have to say very few people actually doing the deals, but lots of interest in doing deals there. But at the same time, extreme concerns about the path to the next elections in 2014 and the rule of law and the security of the investment. So I think very bipolar responses to Indonesia. And then every year you hear about some great opportunities in the smaller countries, Thailand, Malaysia, Vietnam, Philippines. Last year we heard about Laos and Cambodia, and this year, I don't know, I haven't heard about those two countries. This year we heard about the Caucasus regions more than Laos and Cambodia, for example. But to get us into these details, actually, I'll let Megan bring in expertise in the data she sees from Jones Lang LaSalle's point of view.
Thank you. I'm Megan Walters. I work for Jones Lang LaSalle, and we'll just let that one play out on the screen as it goes round. It's interesting that in the advanced economies, they have to reduce their reliance on public debt and increase private demand. And the requirement from different parts of the IMF is that in Asia Pacific, we reduce our reliance on exports and increase domestic demand. Having said that, in a separate IMF report on the regional economic outlook for Asia Pacific, it clearly showed that countries across Asia Pacific are overheating. And they've got a very nice heat map showing that several of these countries across our region are in the throes of overheating. And the restrictions on regulations in China is an example to show how we have administratively or government-engineered slowdowns in much of the markets we have because of an overheating economy. In Jones Lang LaSalle, we look at real estate markets in two ways. We have the market for space, where we help occupiers and tenants find offices, retail, industrial space to undertake their activity. In the other part of the market, we have the market for investors, where we're helping investors, and in this part of the world, owner-occupiers, buy stock, whether that's office, retail, or industrial. Both parts of the market are holding up well. So in contrast to the economic turmoil we see elsewhere in the world, both the market for space and the market for investors are holding up well, possibly for slightly different reasons, which I'll run through. We'll come back to this chart at the end of my 4 slides, but just to set it into context, we've got Europe in the red, Asia Pacific in the orange, and the Americas in the grey colours on the chart. And we use the Jones-Lang LaSalle property clock. It's a cycle, and the cities tend to move around with rents rising, accelerating, rents falling and bottoming out. And as you can see on the chart, primarily we've got mostly now rents accelerating round through, certainly for places like Sydney, Mumbai, Delhi, Beijing, rent growth. For Hong Kong, Singapore and Shanghai, they're towards the top where we've got rent growth tending to slow down. We've had rent rises in those cities of plus 20% over the last year and plus 20% the year before as well. So over the last 2 years, those rents have gone up by something like 40%. And that's a reflection of the great domestic demand that we're seeing in those countries. So it's interesting that the world is still expecting a greater reliance on domestic demand in those countries when actually we have a great deal of that already. When we look at the market for investors, investors generally should be buying what tenants want. So where tenants want to locate should be where investors are buying. And we've got a number of factors that are affecting the real estate markets. The first one is we have sustained tenant demand and strong Asian fundamentals. And any slowdown that we are seeing, to my mind, tends to be government-engineered slowdown to stop overheating. This is clicking. We continue to have an undersupply of investable stock around the region, and that is putting a very solid floor under capital values around the region. We have appreciating Asian currencies, and we have foreign investors continuing to invest in this part of the world. We have Canadian money coming in. We have Swiss money coming in. We have a great deal of money moving around within Asia. So things like a renminbi fund to go down into Australia to invest in Australian property, or you have Singaporean money going up into China. So there's a great deal of money flowing within Asia. One more click. Okay. Obviously, we have a great deal of risk and uncertainty that's coming out. But on the whole, we have negative real interest rates in this part of the world. We have inflation that's continuing to be driven by this great deal of domestic demand that we have. And we have no sign of interest rates rising particularly, or rather we have continuing signs of low interest rates out of the US, which tends to dominate what happens to interest rate policy in this part of the world. So those are some of the pressures that we're going to see across 2012 on the markets. Now, to take this down into a little bit more detail, in order to go back to the property clock, okay, that wasn't right. Okay, sorry. I just want to run through this global credit cycle. Now, this is a chart that I took from the IMF Global Financial Stability Report. It's on page 29, Global Financial Stability Report, September-October 2011 edition. When you look at it in the original report, it's the other way up. So the contribution I made was to literally turn it round so it lines up with the Jones-Lang LaSalle property clock in terms of the recovery, expansion, downturn and repair sectors going round. So it sits the same way as the property clock. I might stand up in a minute, but I'll stay sitting down. I normally like to stand up when I talk, but I'll stay sitting. What this shows is for the different sectors and in the different regions where we are in the credit cycle. So I'd like you to start by looking at the far right-hand side from where you are, which is the green blobs are households. The light blue blobs are the banking sector. Then we run through valuation, credit conditions, asset quality, and corporate fundamentals. The three I'm going to pick out are households in the green, banking sector, and corporate fundamentals to talk about the real estate markets. The households in the green blobs for advanced Europe, US, well, a little bit about Japan, tend to still be in repair mode. So advanced Europe and US households are still repairing their balance sheets, and we can see that from what's going on in the press. In Japan, households have a great deal more savings. They're much more, they're in a recovery mode. The banking sector, the pale blue blobs, for advanced Europe, Japan and the US all remain in the repair phase on this chart, kind of between 3 o'clock and 6 o'clock. on that cycle. The one I really want to draw attention to, though, is to go straight to corporate fundamentals, which is the orange blobs, all placed roughly from 9 o'clock to 12 o'clock on the screen. And what that's showing, from our view, is the continued demand for commercial real estate. So although we might see that markets elsewhere are not doing terribly well, from a corporate fundamentals point of view, corporations still have, they have money to invest, they have money to use. And that goes for the US, Japan, advanced Europe, and for emerging Asia, you'll see the orange blob really quite up in the expansionary mode. So for real estate in this part of the world, what it means is that we have tenant demand coming from two sectors. Western multinational firms that want to come into Asia Pacific to be part of the Asia Pacific growth story, and that's an ongoing trend. So American and European corporations, Western multinationals coming to this part of the world, underpinning tenant demand. And the other one is Asian corporates who are expanding fast, both to service their own domestic base in this part of the world, and then looking to move out to go overseas to see what other markets they can capture. So in terms of talking about the real estate markets, what that means is if you follow the corporate fundamentals of where those blocks are, the orange blobs, it's showing that there's a great deal of acceleration coming on this chart, I suppose, between 6 o'clock to 12 o'clock, but certainly from the 9 o'clock to 12 o'clock position of continued demand for corporate real estate in this part of the world. In this part of the world, we have owner-occupiers that choose to buy property, probably more than you would see in the US and Europe markets. It's partly about the market maturity phase, so we go through owner-occupation first, and then we might go through a sale and leaseback process to generate landlord and tenant style property that you see elsewhere. Landlord and tenant markets do not spring to life fully formed. They need to go through that owner-occupation stage and then into a sale and leaseback phase through the market maturity. So that's one category that we deal with there. And then the other one really is the institutional investors looking to be part of this part of the world. We recently did an exercise where we looked at all private equity funds that have been raised in Asia Pacific over the last 4 years. So we took a database of something like 1,700 funds and looked at all the money they'd raised, and then we matched it up with another database from Jones Lang LaSalle of 10,000 transactions over the last 4 years to see if we could match up money raised with money spent from private equity firms. And actually it matched extremely well, and we were able to identify where most of the money had gone. The only area which was less easy to match up was the money raised for China, where there was considerably more money raised than available built commercial stock for it to go into. So our thinking is there that the money that is currently being raised, either we're raising more money than China can actually absorb, or it needs to go through more of a sale and leaseback process. There needs to be some other steps to go forward in terms of what's going to happen for China going forward. So I'm going to leave you with that chart there. At Jones Lang LaSalle, we have masses of data really on all parts of the market globally. So I'm just going to leave you with the property clock just to show that we're positive on the commercial property markets going forward. And for investors, real estate, it's got strong corporate fundamental demand from tenants, and as a diversification play, it's giving a nice diversification away from some of the volatility we're seeing in the other markets for investors. So with that, I'll pass it back to you.
Thank you.
There we go.
But I can't resist asking you before I push click the button.
Yes.
I mean, you put Hong Kong at the very top of the curve, which means, and I believe those dots never go back, right?
They have been occasionally. Yeah.
So that means that your perspective on Hong Kong is the market has peaked, right? And more so than in Singapore and Shanghai.
Okay, that's an excellent question. Hong Kong has an undersupply of stock going forward. The way we set up these clocks is we model rents going forward, and GDP has a big weight in the model that we use. So if Hong Kong's GDP is forecast to downturn, that would have a reasonably significant effect on the model going forward. But models can sometimes mislead. So the things that may put a floor under Hong Kong is the degree to which China takes its foot off the brakes and allows continued activity, and the continued undersupply of stock in Hong Kong. Our forecast, which is out in our global market perspective fourth quarter, so it's out in the public domain, is that rents in Hong Kong and Singapore may come off by 10% next year. But given that they've risen by 40 or 50% over the last 2 years, a little bit of relief for corporate occupiers is probably a good thing.
So it's a tension between the future of the income. I don't know if you noticed this morning in the news, the IMF adding to a report about the recession, forecasting recession for Hong Kong.
Yes.
With on the other hand, the lack of supply.
Yes.
And that's where the tension is. And,
yes.
And the other thing I learned from this is not you throwing darts, it's actually a model that predicts where this is on the clock.